This podcast is brought to you by Import.top, the stories of top companies. Disclaimer: this AI-generated content is for informational purposes only and should not be considered as investment advice. If you like our podcasts, please subscribe on Apple Podcasts, Spotify, or your favorite podcast player. And don't forget to follow us on X at Import.top. Find thousands of stories of top companies on our website, Import.top. Import.top is brought to you by HeyFin.co. Fin is a personalized junior AI research assistant for equity portfolio managers. Check it out at HeyFin.co. VRTS Investment Partners. The story of a multi-boutique asset manager. Picture this: a company managing over $150 billion in assets, with 15 distinct investment boutiques under its umbrella, run by about 800 employees out of Hartford, Connecticut. And yet, if you stopped the average investor on the street and asked them about VRTS Investment Partners, you'd almost certainly get a blank stare. This is not BlackRock. This is not Vanguard. This is not even a household name among financial advisors. But VRTS may be one of the most fascinating transformation stories in modern asset management. A tale of survival, reinvention, and the relentless pursuit of a model that somehow works in an industry where the gravitational pull toward passive indexing has destroyed dozens of active managers. Here's the question at the heart of this story. How did a Hartford insurance company's investment management arm, spun off at the absolute worst moment in financial history, claw its way from $22 billion in assets under management to a peak of $170 billion? And what does that journey tell us about the future of active management in an era when most experts have declared it dead? The answer lies in what the industry calls the multi-boutique model. Rather than building one monolithic investment firm with a single culture and process, VRTS assembled a federation of specialized investment managers, each with their own philosophy, team, and identity, all operating under one corporate umbrella. Think of it as the Berkshire Hathaway approach applied to asset management. Buy great teams, leave them alone to do what they do best, and provide the plumbing, distribution, and capital they need to grow. This is a story about survival through the 2008 financial crisis, strategic transformation through a decade of acquisitions, and the ultimate test facing every active manager today. Can you justify your fees in a world where an index fund costs almost nothing? The answer, as we'll see, is complicated, fascinating, and still very much unresolved. The key themes we'll explore are threefold. First, the art of the roll-up, how VRTS built its acquisition playbook, and what separates a good deal from a bad one in asset management. Second, the multi-boutique model itself, why it works in theory, where it breaks down in practice, and what the economics actually look like under the hood. And third, the existential question facing the entire active management industry. What happens when the tide of passive investing meets the immovable object of human talent and specialized expertise? In 1851, a group of prominent Hartford businessmen, religious leaders, and civic figures pooled their resources to found the American Temperance Life Insurance Company. The premise was radical for its time. The company would only insure individuals who abstained from alcohol, a bet that sober policyholders would live longer and cost less in claims. Hartford was already becoming the insurance capital of America, and this new venture fit neatly into the city's growing financial ecosystem. As the temperance movement faded from cultural prominence, the company recognized it needed a broader mandate. In 1860, it rebranded as Phoenix Mutual Life Insurance Company, dropping the abstinence requirement and opening its doors to all comers. The name change proved prescient in more ways than one. Phoenix Mutual would rise, fall, and rise again repeatedly over the next century and a half, much like its mythological namesake. The company famously insured President Abraham Lincoln and paid the claim to his survivors after the assassination in 1865, an early demonstration of institutional credibility that would serve the brand well for generations. Over the next 130 years, Phoenix Mutual grew steadily through the insurance industry's golden age, merging with Home Life Insurance Company in 1992 to become Phoenix Home Life Mutual Insurance Company. But the really interesting part of the story the part that gives birth to VRTS, begins in the mid-1990s. Insurance companies have always needed to manage enormous pools of capital. The premiums they collect, the reserves they maintain, the float that sits between when money comes in and when claims go out. For most of insurance history, this was handled internally. But by the 1990s, the asset management industry had evolved into its own profit center, and insurance companies began to realize their investment arms could be monetized as standalone businesses. This was the era when many of today's asset management giants were born from insurance parentage. Lincoln National spun out Delaware Investments, Cigna's investment arm became separate, and dozens of similar transactions played out across the industry. On November 1, 1995, Phoenix created its dedicated asset management subsidiary through a reverse merger combining Phoenix Home Life's investment operations with Duff & Phelps Corporation, creating Phoenix Investment Partners with approximately $35 billion in combined assets. This was the moment that planted the seed for everything that would follow. The newly formed entity immediately began assembling a portfolio of boutique managers, acquiring stakes in Kayne Anderson Rudnick in 2002, GMG/Seneca Capital Management in 1997, and Zweig Advisors in 1998. The multi-boutique DNA was there from the very beginning. Then came the demutualization wave. In 2001, Phoenix converted from a mutual company owned by its policyholders to a publicly traded stock company, becoming the Phoenix Companies, Inc., listed on the New York Stock Exchange under the ticker PNX. This was part of a broader industry trend. MetLife, Prudential, and John Hancock all demutualized around the same time, driven by the logic that public markets could provide growth capital that mutual structures could not. But here's the crucial detail that sets the stage for everything that follows. The Phoenix Company's insurance business was struggling. The parent company would eventually be acquired by Nassau Financial Group in 2016. But long before that, it became clear that the asset management arm was far healthier than the insurance operation it served. The question became, could the investment management business stand on its own? On February 7, 2008, the Phoenix Companies made an announcement that would either prove brilliant or catastrophic, depending on how the next 12 months played out. The company declared its intention to spin off Phoenix Investment Partners as an independent, publicly traded entity. The asset management business would be rebranded as VRTS Investment Partners, a name derived from the Latin word for virtue and strength. The timing seemed reasonable. Markets were choppy but not yet in free fall, and the strategic logic was sound. Separate the healthy asset management business from the struggling insurance parent. Give it its own stock, its own board, and the freedom to pursue its own destiny. Then Lehman Brothers collapsed. The spin-off was completed after market close on December 31, 2008, quite literally in the final hours of the worst year for financial markets since the Great Depression. Phoenix shareholders received 1 share of VRTS for every 20 shares of Phoenix they held. The newly independent company was born into chaos. Assets under management, which had stood at $40 billion in 2007, had been slashed nearly in half to $22.6 billion by the time of the spinoff, as market declines and client redemptions ravaged the portfolio. There is a detail worth noting here that speaks to George Aylward's foresight as a leader. Before the spinoff, Aylward, who had been named president of Phoenix Investment Partners in 2006, orchestrated a deal with Harris Bancorp, a subsidiary of Bank of Montreal, to invest $45 million in convertible preferred stock, giving Harris a 23% equity position in the new company. This was not just capital, it was a lifeline. In the midst of the worst financial crisis in 80 years, having a strong banking partner willing to put real money into your company was the difference between survival and oblivion. George Aylward had joined Phoenix Investment Partners' corporate finance team in 1996, after starting his career at Price Waterhouse in the financial services group. Born in 1964, he held degrees from the University of Connecticut and the University of Massachusetts, along with a CPA designation. He had served as chief of staff to the CEO of the Phoenix Companies from 2002 to 2004, then as COO of the investment management subsidiary, before being elevated to president. He was an operations and finance person by training, not a portfolio manager or investment star. This would prove to be exactly the right profile for what the company needed. Someone who could build systems, structure deals, and create a platform, rather than someone who wanted to manage money personally. VRTS began trading on NASDAQ on January 2, 2009. The stock opened in the single digits. Trading volumes were anemic, some days seeing only a few thousand shares change hands. The company was a rounding error in the financial services universe, too small to appear on most institutional investors' radars, too obscure for retail investors to notice. But it was alive. And in the winter of 2009, that counted for something. The first 2 years of VRTS's independent existence were a study in survival. The stock traded in the low single digits through early 2009, touching as low as $4 in March of that year, when the broader market hit its crisis nadir. Daily trading volumes regularly dipped below 10,000 shares. This was a company that the market had essentially written off, an orphaned spin-off from a troubled insurance company, dumped into public markets at the worst possible moment, with no natural shareholder base and no analyst coverage to speak of. But George Aylward and his team, including CFO Michael Angerthal, who had joined in 2008 specifically to prepare the company for independence, had a plan. Angerthal brought a distinctive background to the role. He had earned his BBA in accounting from Pace University and an MBA in corporate finance from Columbia Business School, then spent 9 years across several GE units, including GE Capital and GE Real Estate, absorbing the GE playbook of disciplined financial management and operational efficiency. Before joining VRTS, he had served as CFO of CBRE Realty Finance. Together, Aylward and Angerthal formed a leadership duo that combined strategic vision with financial discipline, a combination that would prove essential in the years ahead. The post-crisis asset management landscape was brutally Darwinian. The first wave of money flowing into passive index funds was accelerating, driven by the humiliation that most active managers had suffered during the crisis. Fee compression was beginning to bite, and for a firm of VRTS's size, roughly $20 billion in AUM, the competitive position was precarious. Too small to compete with the giants on distribution and brand recognition, too large to operate as a nimble boutique with a single concentrated strategy. They were stuck in what strategy consultants call the valley of death for mid-sized asset managers. The company's early strategy was straightforward: stabilize the existing business, retain investment talent, and begin building the infrastructure that would support future growth. VRTS already had a few strong boutiques within its portfolio, most notably Kayne Anderson Rudnick, a Los Angeles-based firm specializing in high-quality growth equities. Kayne Anderson Rudnick had been partially acquired by Phoenix back in 2002, with full ownership following in September 2005. The firm had a distinctive investment philosophy centered on owning high-quality companies with strong competitive positions, and it would eventually become the single most important asset within the VRTS empire. By 2011, the team began testing the acquisition playbook that would define the next decade. In June of that year, VRTS executed a team lift-out from ING to create New Fleet Asset Management, bringing over approximately $5.2 billion in multi-sector fixed-income assets. This was not a traditional acquisition of a corporate entity. It was a recruitment of a team, which is often the most effective way to build an asset management business because the relationships and investment process travel with the people, not the corporate shell. The following year, VRTS completed 2 more deals. In October 2012, it acquired Rampart Investment Management, a Boston-based firm specializing in customized option strategies, managing about $1.4 billion. In December 2012, it added Euclid Advisors, bringing international equity capabilities through a team of industry veterans. These were small deals by any measure, but they were teaching VRTS how to identify, evaluate, integrate, and retain boutique teams. Each deal was a rehearsal for the larger transactions that would follow. The stock, meanwhile, began its recovery. From that $4 nadir in March 2009, shares climbed steadily through 2012 and into 2013, reflecting both the broader market recovery and growing investor recognition that VRTS was building something different. Revenue grew from approximately $322 million in 2016, the earliest full-year figure in the available data, having built up from much smaller figures in the early years. The multi-boutique thesis was taking shape, but the real transformation was still ahead. Every great corporate transformation has an inflection point, a moment when the leadership team stops experimenting and fully commits to a strategic direction. For VRTS, that moment arrived in the mid-2010s, when the company shifted from opportunistically adding boutiques to systematically building a multi-boutique aggregator platform. To understand why this mattered, it helps to understand the multi-boutique model itself. Imagine you are a talented portfolio manager running a small investment firm. You are brilliant at picking stocks, but you hate dealing with compliance, technology, marketing, fund administration, and the dozens of intermediaries who stand between you and the end investor. You have two choices: stay independent and struggle with all of that overhead, or sell your firm to a large asset manager and risk losing your autonomy, your culture, and eventually, your best people. The multi-boutique model offers a third path. You sell a majority stake to a parent company like VRTS, which takes over all the operational and distribution headaches, but you retain control over your investment process, your team, your brand identity, and your day-to-day culture. It is the best of both worlds, at least in theory. Affiliated Managers Group, or AMG, had pioneered this model starting in the 1990s, typically taking minority equity stakes in independent managers. VRTS took a different approach, generally acquiring majority or full ownership positions, which gave it more control but also more responsibility for integration. Victory Capital, another peer, developed yet another variation, fully integrating acquired firms onto a single operating platform while preserving some degree of investment autonomy. In January 2015, VRTS acquired ETF Issuer Solutions, later renamed VRTS ETF Solutions, which gave the company a platform for listing and distributing exchange-traded funds. This was a small but strategically important move. ETFs were clearly the growth vehicle in asset management, and having the plumbing in place to launch and distribute ETFs would prove valuable as the company grew. But the true game-changer of this era was not a small bolt-on. It was the deepening relationship with Kayne Anderson Rudnick. Though KAR had been part of the VRTS family since the Phoenix days, the boutique's investment performance during the post-crisis bull market was exceptional, and its assets under management were growing rapidly. By the mid-2010s, KAR was becoming the crown jewel of the VRTS portfolio, specializing in high-quality small and mid-cap growth equities with a process rooted in fundamental research and a focus on companies with sustainable competitive advantages. The firm was based in Los Angeles, far from Hartford, and operated with almost complete autonomy, exactly the way the multi-boutique model was designed to work. Then came the deal that truly transformed the company's scale. In June 2017, VRTS acquired Ridgeworth Investments from Lightyear Capital for $472 million. This was a transformative transaction by every measure. Ridgeworth brought approximately $40 billion in assets under management across 3 affiliated boutiques: Saradex Value Advisors, Sex Investment Advisors, and Sylvant Capital Management. In a single stroke, VRTS roughly doubled its AUM from approximately $50 billion to $90 billion. The Ridgeworth deal illustrated both the opportunities and risks of the multi-boutique roll-up. On the opportunity side, VRTS was acquiring established teams with strong track records at a time when smaller multi-boutique platforms were struggling to compete independently. On the risk side, integrating 3 new affiliates simultaneously, each with its own culture and investment approach, while maintaining the autonomy that made those teams valuable in the first place, was an enormous operational challenge. The purchase price of nearly $500 million was significant for a company of VRTS's size, and the debt taken on to fund the deal would remain on the balance sheet for years. Revenue jumped from $322 million in 2016 to $424 million in 2017, a 32% increase driven largely by the Ridgeworth integration. Earnings per share more than doubled. The market took notice, and Virtus's stock, which had been trading around $118 at the end of 2016, climbed to $115 by year-end 2017, reflecting both the scale benefits and investor concerns about digesting such a large acquisition. With the Ridgeworth integration underway, Virtus entered a period of consolidation and selective growth. The company needed to prove that it could digest a major acquisition while maintaining investment performance across its expanding roster of boutiques. This was the operational test that would determine whether Virtus was a real platform or just a collection of disparate investment firms stapled together under a common corporate name. The key to Virtus's integration approach was a principle that sounds simple, but is extraordinarily difficult to execute. Centralize everything that doesn't touch the investment process, and decentralize everything that does. Distribution, compliance, technology, fund administration, accounting, legal, and HR were all handled at the parent company level. Investment decisions, portfolio construction, research, client relationships, and team management remained firmly within each boutique. This created what management described as operational leverage. Each new affiliate added to the platform benefited from existing infrastructure without requiring proportional increases in corporate overhead. The financial results during this period told a mixed story. Revenue climbed to $551 million in 2018 and $562 million in 2019, reflecting the full contribution of Ridgeworth assets. But net income was more volatile, as the company navigated market gyrations, fee compression across the industry, and the ongoing costs of building out its platform infrastructure. Earnings per share came in at roughly $9 in 2018, then jumped to nearly $12 in 2019 as operating efficiencies began to materialize. In July 2018, Virtus made another significant move, acquiring a 70% stake in Sustainable Growth Advisors, or SGA, for $105 million. SGA was a Stamford, Connecticut-based growth equity manager with $11.6 billion in assets, primarily from institutional clients. This was a different kind of acquisition for Virtus. SGA brought a predominantly institutional client base compared to the retail-heavy mix of most Virtus affiliates, and its focus on large-cap growth equities complemented Kayne Anderson Rudnick's small and mid-cap orientation. The SGA deal also illustrated a key element of how Virtus structured its acquisitions. Rather than buying 100% of each firm outright, Virtus often acquired majority stakes, leaving existing partners with meaningful equity ownership and alignment. This approach served multiple purposes. It reduced the upfront purchase price, it kept the founding team financially motivated, and it ensured that the investment professionals who made the firm valuable in the first place had every incentive to stay and grow the business. The industry backdrop during this period was increasingly challenging. The relentless flow of capital from active to passive strategies was accelerating, with index funds and ETFs gathering hundreds of billions in net new assets each year, while active equity managers hemorrhaged capital. Virtus's response was to lean into what it did best: specialized, differentiated active strategies where boutique managers could demonstrate genuine edge. The company was not trying to compete with Vanguard on fees or BlackRock on scale. It was betting that there would always be a market for genuinely talented active managers, particularly in less efficient corners of the market like small-cap equities, event-driven strategies, and multi-sector fixed income. By the end of 2019, Virtus had built a platform with approximately $100 billion in total assets, up from $22 billion at the time of the spin-off a decade earlier. The stock had risen from single digits to over $120. The multi-boutique thesis was working, at least in the aggregate. But the real tests, both of the model and of the company's ambitions, were about to arrive. The year 2018 delivered a sharp reminder that asset management is, at its core, a leveraged bet on market levels. The fourth quarter of that year saw the S&P 500 drop nearly 20% from its September highs, and for asset managers whose revenue is calculated as a percentage of assets under management, that kind of decline hits the income statement immediately and mercilessly. There is no inventory to sell through, no backlog to work off. When markets fall, revenue falls with them, often before expenses can be adjusted. Virtus navigated this volatility with the discipline that characterized Aylward's management approach. The company did not panic cut teams, did not abandon its acquisition strategy, and did not chase short-term performance by encouraging its boutiques to deviate from their investment processes. This patience would pay off when markets recovered in 2019, but the episode underscored a fundamental vulnerability of the asset management business model. Revenues are inherently volatile, tied to the unpredictable movements of global financial markets, while costs, particularly the compensation of highly skilled investment professionals, are relatively fixed. The industry headwinds during this period were not just cyclical. The structural shift from active to passive management was accelerating, driven by three reinforcing dynamics. First, the academic evidence that most active managers underperform their benchmarks over long periods continued to accumulate. Second, the fee gap between active and passive had widened to the point where active managers needed to outperform by hundreds of basis points just to break even with a cheap index fund. Third, the rise of financial advisors using model portfolios built around passive ETFs was reducing the demand for actively managed mutual funds that had been Virtus's bread and butter. Virtus's response to these headwinds was both strategic and tactical. Strategically, the company began shifting its acquisition focus toward higher-fee, stickier asset classes, particularly alternatives and event-driven strategies. Tactically, it invested heavily in its distribution platform, building relationships with the wirehouses, registered investment advisors, and institutional consultants who controlled access to the end investor. In 2020, as the pandemic struck, Virtus completed its acquisition of Westchester Capital Management in October for $135 million. Westchester was a specialist in global event-driven strategies, best known as the home of the Merger Fund, which had been launched in 1989 as the first mutual fund devoted exclusively to merger arbitrage. This was exactly the kind of differentiated, hard-to-replicate strategy that the multi-boutique model was designed to attract. A highly specialized team with decades of experience in a niche that passive funds could not easily replicate. The pandemic itself created an unexpected operational test for Virtus. The multi-boutique model, with its emphasis on boutique autonomy and distributed decision-making, turned out to be naturally suited to remote work. Each boutique was already accustomed to operating independently, making its own investment decisions, and managing its own team dynamics. The centralized corporate functions, distribution, compliance, technology, could transition to remote work without disrupting the investment process at any of the affiliates. This structural resilience, while not planned, became an unexpected advantage during a period when many monolithic asset managers struggled with the cultural and operational challenges of sudden remote work. Revenue for 2020 came in at $603 million, reflecting both market dislocations and the partial year contribution of the Westchester acquisition. Earnings per share were approximately $10 diluted. But the seeds of the next phase of growth had already been planted. The 18 months following the pandemic crash represented arguably the most consequential period in Virtus's history. As markets recovered with stunning velocity, propelled by unprecedented fiscal and monetary stimulus, Virtus executed a series of acquisitions that dramatically reshaped the company's profile and ambitions. The first major move came in February 2021, when Virtus announced a strategic partnership with Allianz Global Investors. Under this agreement, Virtus became the advisor and distributor for approximately $23 billion in Allianz-managed retail mutual fund assets, and the NFJ Investment Group, managing roughly $7 billion in value-oriented equities, joined Virtus as an affiliated manager. This partnership increased Virtus's mutual fund assets by approximately 40% overnight, to about $54 billion. It was a creative deal structure. Rather than a traditional acquisition, it was a partnership that gave Virtus distribution rights and fee income without the full cost of acquiring a corporate entity. Then, in January 2022, Virtus closed on the acquisition of Stone Harbor Investment Partners, a specialist in emerging markets debt and multi-asset credit, managing approximately $14.7 billion. Stone Harbor brought institutional credibility in a fixed-income niche that was difficult to replicate organically and that commanded premium fees. The combined impact of these deals was dramatic. Revenue surged from $603 million in 2020 to $975 million in 2021, an increase of more than 60%. Net income more than doubled to $208 million, and diluted earnings per share hit $26. The stock price responded accordingly, reaching $297 by the end of 2021, a return of roughly 3,000% from the post-spin-off lows. For investors who had bought VRTS at $4 in March 2009 and held through all the volatility, this was a generational wealth creation story. But the alternatives push was about more than just scale. It reflected a fundamental strategic insight. In a world where passive funds were eating the lunch of traditional active equity and fixed income managers, the best defense was to move into asset classes where passive alternatives did not exist or were impractical. Merger arbitrage, event-driven strategies, infrastructure investing, emerging markets debt, liquid alternatives. These were all areas where human judgment, specialized expertise, and relationship networks still mattered, and where fees could be maintained at levels that justified the cost of maintaining autonomous boutique teams. By the end of 2021, VRTS had quietly built what amounted to a $40 billion-plus alternatives and multi-asset platform, representing roughly 22% of total assets under management. This was not the kind of alternatives business that a Blackstone or KKR would recognize. It was not private equity or real estate with locked-up capital. But within the world of liquid and semi-liquid alternatives, accessible to retail and institutional investors through mutual funds and separate accounts, it was a significant and growing franchise. The year 2022, however, brought a harsh reality check. As the Federal Reserve embarked on its most aggressive interest rate hiking cycle in decades, both equity and fixed income markets declined simultaneously, a rare and painful combination for multi-asset managers. VRTS's AUM declined from its 2021 highs, and net outflows resumed as clients redeemed from strategies that had suffered market-related losses. Revenue held relatively steady at $882 million, but net income declined to $118 million as market headwinds and integration costs weighed on profitability. The stock pulled back sharply from its highs. The post-2022 environment has tested VRTS's model in ways that the bull market of 2020 to 2021 never could. The company has faced a triple challenge: persistent outflows from traditional active equity strategies, fee compression across the industry, and a stock price that has declined significantly from its 2021 peaks. As of mid-March 2026, shares trade around $126, roughly 40% below their all-time highs, with a market capitalization of approximately $850 million. The financial performance, however, has been more resilient than the stock price suggests. Revenue came in at $841 million in 2023, dipped slightly, then declined to $831 million in 2025. But net income actually increased from $131 million in 2023 to $138 million in 2025, and diluted earnings per share climbed from $17.71 to nearly $20, reflecting the impact of share repurchases and operational efficiencies. The company has been actively buying back stock, reducing diluted shares outstanding from 7.6 million in 2022 to 6.9 million in 2025, a reduction of nearly 10%. Assets under management, after peaking at $170.7 billion in mid-2025, have declined to $155.9 billion as of February 2026, driven by net outflows of $8.1 billion in the fourth quarter of 2025 alone. These outflows have been concentrated in quality-oriented equity strategies, precisely the area where passive alternatives are most competitive and where fee sensitivity is highest. Management's response has been to accelerate the push into private credit and alternative strategies, areas where passive alternatives are essentially non-existent and fee levels remain attractive. In December 2025, VRTS acquired a 35% minority stake in Crescent Cove Advisors, a San Francisco-based private credit firm specializing in lending to middle-market technology companies, with approximately $1 billion in assets. In the same month, the company announced an agreement to acquire a majority interest in Keystone National Group, described as a pioneer in wealth channel private credit strategies. The Keystone deal closed on March 1, 2026, just 2 weeks before this writing. These moves represent a meaningful strategic evolution for VRTS. Where the company once focused almost exclusively on liquid, daily valued strategies distributed through mutual funds and separate accounts, it is now building capabilities in private credit, an asset class with higher fees, stickier capital, and structural barriers to passive competition. The wealth channel angle is particularly interesting. As registered investment advisors and wealth managers increasingly seek to offer their clients access to private market strategies that were historically available only to institutional investors, platforms like VRTS that can package and distribute these strategies through familiar fund structures stand to benefit from a major secular trend. The ETF business has also emerged as a bright spot. VRTS's ETF assets reached approximately $4.7 billion by the end of 2025, with a 74% organic growth rate over the trailing 12 months. The company launched the VRTS KAR Midcap ETF in October 2024 and the VRTS Sylvant Growth Opportunities ETF in 2025, leveraging the investment capabilities of its boutiques in the industry's fastest-growing distribution vehicle. George Aylward remains at the helm as president and CEO, now in his 18th year leading the company through its independence. His total compensation of approximately $3.7 million, while significant, is modest by the standards of financial services CEOs running comparably complex organizations. The leadership team has been remarkably stable, with CFO Angerthal, COO Richard Smurl, Head of Distribution Barry Mandanak, and Chief Legal Officer Andra Perkalitis all serving in their roles for many years. This continuity has been a quiet advantage. In an industry where leadership turnover can trigger client and talent departures, VRTS's management stability has provided a foundation of trust for both affiliated boutiques and external stakeholders. To truly understand VRTS, you need to understand how the money flows through the machine. At its simplest, VRTS earns investment management fees, a percentage of assets under management charged annually but collected monthly or quarterly. The 2025 revenue breakdown tells the story. Of the company's $831 million in total revenue, $725 million came from investment management fees. Within that, open-end mutual funds contributed $287 million, retail separate accounts $210 million, institutional accounts $168 million, and closed-end funds $61 million. The average fee rate across the platform runs at approximately 42 basis points, or roughly 0.4% of assets managed annually. This is meaningfully higher than the industry average for traditional active managers, and dramatically higher than the single-digit basis point fees charged by passive index funds. The premium reflects VRTS's concentration in specialized strategies, small and mid-cap equities through Kayne Anderson Rudnick, multi-sector fixed income through Newfleet, event-driven strategies through Westchester, and emerging markets debt through Stone Harbor, where the value of active management is more demonstrable and where passive alternatives are less available or less effective. The affiliate structure is the architectural innovation that makes the whole thing work. VRTS owns majority or full equity stakes in each of its 15-plus boutiques. Each affiliate operates under a management agreement that specifies the revenue-sharing arrangement. The boutique retains a portion of the investment management fees it generates, typically reflecting the costs of its investment team and a profit-sharing component, while VRTS retains the remainder to cover corporate overhead, distribution costs, and profit. Distribution is perhaps the single most important value add that VRTS provides to its boutiques. The company employs a large wholesaling force, led by Executive VP Barry Mandanak, that maintains relationships with the broker-dealers, wirehouses, and RIA platforms that control access to the end investor. For a boutique managing $5 billion in assets, building and maintaining this distribution infrastructure independently would be prohibitively expensive. Through VRTS, they get access to a distribution machine that covers the entire intermediary landscape without having to build it themselves. Why do boutiques partner with VRTS rather than staying independent or joining competitors? The answer boils down to a simple economic calculation. An independent boutique managing $10 billion faces a harsh reality. After paying for compliance, technology, fund administration, back-office operations, marketing, and distribution, the margin on the business can be thin, particularly for smaller firms. By joining VRTS, the boutique founders receive a significant upfront payment for their equity, ongoing revenue sharing that typically exceeds what they could earn independently, and the freedom to focus exclusively on investment management rather than running a small business. The retention game is equally important. In asset management, the assets follow the people. If a key portfolio manager leaves, their clients often follow, sometimes within weeks. VRTS structures its affiliate agreements with long-term incentive arrangements that keep key personnel financially aligned over multi-year periods. The combination of equity participation, attractive revenue sharing, and operational autonomy creates what management describes as golden handcuffs that are both generous and genuinely desired, a critical distinction from the coercive retention structures that have failed at other firms. The capital-light nature of the business deserves emphasis. Unlike banks, which need massive balance sheets to support lending, or insurance companies, which need reserves to back policies, asset managers need relatively little capital to operate. VRTS's primary assets are its people, its relationships, and its contractual agreements with affiliates. The company's balance sheet carries significant goodwill and intangible assets from past acquisitions, but the ongoing capital requirements of the business are modest, which allows for substantial free cash flow generation relative to revenue. That said, the model has clear limitations. The reliance on Kayne Anderson Rudnick, which accounts for roughly 40% of total AUM, creates significant concentration risk. If KAR's investment performance deteriorates, or if key personnel depart, the impact on VRTS would be severe. The multi-boutique structure also creates complexity. Each affiliate has its own investment process, risk management framework, and operational needs, which makes the parent company's oversight function more challenging than it would be in a monolithic firm. The asset management industry has undergone a tectonic shift over the past 2 decades, and VRTS sits at the intersection of nearly every major trend reshaping the business. On one side, the passive investing revolution has created an oligopoly of mega managers, BlackRock, Vanguard, and State Street, that together control over $20 trillion in assets and continue to gather the lion's share of net new flows. On the other side, specialized boutiques with genuine investment edge continue to thrive in niches that passive strategies cannot easily replicate. The middle ground, where mid-sized active managers historically lived, has become a killing field. VRTS's most direct peer is Affiliated Managers Group, or AMG, the firm that essentially invented the multi-boutique model in the 1990s. AMG takes a different approach, typically acquiring minority equity stakes in larger, more established independent managers. AMG's assets under management of approximately $813 billion dwarf VRTS's $156 billion, and its focus on alternatives and private markets is more mature, with private markets and liquid alternatives representing a majority of EBITDA. But AMG has faced its own challenges, including the departure of several high-profile affiliates and questions about whether its minority stake model provides sufficient control to manage risk effectively. Victory Capital, trading under the ticker VCTR, represents the more aggressive end of the multi-manager spectrum. Victory operates 12 autonomous investment franchises on a fully integrated centralized operating and distribution platform, combining boutique investment autonomy with industrial-scale operational efficiency. In April 2025, Victory completed a transformative strategic partnership with Amundi, acquiring Amundi's U.S. business, which included the Pioneer Investments brand and approximately $119 billion in AUM. Victory's CEO has publicly targeted $1 trillion in AUM, a level of ambition that makes VRTS look conservative by comparison. With a market capitalization of approximately $9 billion, Victory trades at a significant premium to VRTS, reflecting the market's belief in its superior growth trajectory. Federated Hermes, listed as FHI, is often mentioned in the same breath as VRTS, but operates a fundamentally different business. Federated manages approximately $903 billion, a record figure achieved in mid-2025, but more than half of its revenue comes from money market and liquidity assets, a business that bears little resemblance to Virtus's focus on active equity, fixed income, and alternatives. The money market business provides stable, fee-driven revenue with limited market sensitivity, but it also operates at razor-thin margins and is vulnerable to disruption from direct money market access through platforms like Treasury Direct. Then there are the diversified players, Franklin Templeton and Invesco, that have attempted to compete across virtually every asset class and distribution channel. These firms have the scale and brand recognition that Virtus lacks, but they also carry the organizational complexity and cultural challenges that come with trying to be all things to all investors. Franklin Templeton's acquisition of Legg Mason in 2020 was arguably the largest and most ambitious deal in the multi-boutique space, combining two multi-affiliate platforms into a single entity managing over $1.5 trillion. The distribution landscape deserves special attention because it is the single most important competitive battleground in asset management outside of investment performance itself. There are essentially three distribution channels that matter: the wirehouses and broker-dealers that serve high-net-worth individuals, the registered investment advisor channel that has been the fastest-growing segment for a decade, and the institutional consultants that advise pension funds, endowments, and foundations. Virtus has historically been strongest in the intermediary channel, selling through broker-dealers and increasingly through RIA platforms. Its institutional presence, while growing through affiliates like SGA and Stone Harbor, remains a relative weakness compared to larger competitors. The secular trends shaping the industry are largely unfavorable for traditional active managers, but not uniformly so. Passive growth continues to accelerate, but the explosion of alternative investments, particularly in private credit, infrastructure, and real assets, has created new opportunities for firms with the right capabilities. Fee compression is real and ongoing, but it is most acute in large-cap equity and core fixed income, where Virtus has limited exposure. The consolidation thesis, the idea that the industry will continue to consolidate as smaller managers struggle to achieve viable scale, generally benefits platforms like Virtus that can serve as acquirers. Porter's 5 forces. The threat of new entrants in asset management is paradoxical. On one hand, starting a boutique investment firm has never been easier. Two talented portfolio managers with a Bloomberg terminal and a compliance consultant can launch a hedge fund or separate account business from their living room. The barriers to creating a fund are low. On the other hand, the barriers to building a scaled distribution platform are enormous. Getting on the approved lists at major wirehouses, building relationships with institutional consultants, achieving the AUM thresholds required by major platforms. These take years of effort and millions of dollars in distribution spending. Virtus's value proposition to boutiques is precisely this. It provides the scaled distribution infrastructure that would take a new entrant decades to build. Supplier power in asset management is uniquely high because the suppliers are the investment professionals themselves. In manufacturing, if a supplier raises prices, you can find another supplier. In asset management, if your star portfolio manager leaves, the assets walk out the door with them. This is perhaps the single greatest risk in the multi-boutique model. Each boutique is, in essence, a small team of individuals whose departure would immediately destroy value. Virtus mitigates this risk through equity participation, revenue sharing, and cultural autonomy. But the risk can never be fully eliminated. Buyer power has increased dramatically over the past decade. Institutional investors have become far more sophisticated in evaluating fees, and the rise of fee-based advisory models in the retail channel has created intense pressure on fund expense ratios. Platform access matters enormously. Being included on or excluded from a major wirehouse's recommended list can mean billions of dollars in flows. Virtus's distribution team exists precisely to navigate these gatekeepers. The threat of substitutes is the existential challenge facing the entire active management industry. Passive index funds, direct indexing, factor-based ETFs, and increasingly sophisticated do-it-yourself tools all represent alternatives that are cheaper and, in many cases, deliver comparable or superior long-term returns. VRTS's defense against substitution is specialization. Its boutiques operate in niches where passive alternatives are less effective, less available, or non-existent. Competitive rivalry is intense and increasing. As the total addressable market for traditional active management shrinks, the remaining firms are competing more aggressively for a declining pool of assets. Scale advantages are emerging. Larger firms can spread distribution and technology costs across a bigger asset base, reducing per-unit costs and allowing for more competitive fee structures. This dynamic favors consolidation and makes it harder for mid-sized firms like VRTS to compete purely on price. Hamilton's 7 Powers. Scale economics in asset management are moderate. Distribution and operations benefit from scale, as the cost of maintaining a wholesaling force or a technology platform does not increase linearly with AUM. However, the boutique structure inherently limits scale economies at the investment management level. Each boutique remains relatively subscale compared to monolithic competitors. The corporate parent captures some scale benefits, but these are partially offset by the revenue-sharing arrangements with affiliates. Network economics are essentially absent in traditional asset management. Unlike a platform business where each additional user makes the service more valuable to existing users, adding a new client to an investment fund does not meaningfully benefit existing clients. There are weak network effects in distribution, where broader platform coverage can attract more boutiques, which in turn attract more clients, but these effects are modest. Counterpositioning is moderate. The multi-boutique model positions VRTS differently from monolithic firms, offering a combination of investment specialization and operational scale that traditional competitors cannot easily replicate. However, this positioning is not unique to VRTS. AMG, Victory Capital, and others offer similar value propositions, limiting the defensive value of this particular form of counterpositioning. Switching costs are moderate for institutional clients, who face search costs, transition costs, and governance hurdles when changing managers, but are low for retail investors, who can redeem from a mutual fund with a phone call or a mouse click. The stickiness of alternative and private credit strategies, where capital is often locked up for longer periods, is one reason VRTS's push into these areas is strategically important. Branding power is weak at the VRTS corporate level, but stronger at the boutique level. Kayne Anderson Rudnick, Stone Harbor, and Westchester Capital have meaningful brand recognition within their respective niches. Few investors, however, choose a fund because it carries the VRTS name, and corporate brand awareness remains limited outside the financial advisor community. Cornered resources are limited. Investment talent is inherently mobile. Portfolio managers can and do leave for competitors or to start their own firms. While VRTS's retention structures are well designed, they cannot permanently lock in talent the way a patent locks in intellectual property. Process power is moderate. VRTS has developed a repeatable acquisition playbook, from sourcing and evaluating potential affiliates to structuring deals with appropriate incentive alignment to integrating new firms onto the corporate platform. This institutional capability is difficult to replicate quickly and represents a genuine, if modest, competitive advantage. The overall assessment is sobering for long-term investors. VRTS lacks the kind of deep, durable moats that characterize the best compounding businesses. Its success depends primarily on execution quality, talent retention, acquisition discipline, and market conditions, factors that are difficult to predict and impossible to control. Asset management is ultimately a hits-driven, people-dependent business, and the multi-boutique model, for all its elegance, does not change that fundamental reality. Bull case. The case for VRTS begins with the industry consolidation thesis. As the asset management industry continues to bifurcate between passive giants and specialized active managers, mid-sized firms are being forced to either achieve scale or be acquired. VRTS, with its proven acquisition playbook and established platform infrastructure, is well-positioned to be a consolidator rather than a target. Every boutique that struggles with distribution, compliance, or operational costs is a potential acquisition target, and there are hundreds of them. The alternatives growth story provides a second pillar. The shift toward alternative investments, particularly private credit, is a secular trend that plays directly to the multi-boutique model's strengths. These strategies command higher fees, generate stickier capital with longer lockup periods, and face essentially no competition from passive alternatives. VRTS's recent acquisitions of stakes in Crescent Cove and Keystone National Group suggest management is positioning aggressively for this opportunity. The company's investment performance across many of its boutiques has been strong, with Kayne Anderson Rudnick in particular delivering consistent results in quality-oriented growth equities. When performance is good, organic growth follows, and the compounding effect of positive flows on a fee-based revenue model can be powerful. Valuation offers another argument. At a market capitalization of roughly $850 million, VRTS trades at a notable discount to peers like Victory Capital and Federated Hermes on most conventional metrics. With nearly $20 per share in earnings and a quarterly dividend of $2.40, the stock offers a dividend yield above 7%, unusually high for an asset manager of this quality. If the discount to peers narrows, or if a private equity buyer recognizes the value of the platform and takes the company private, significant upside exists from current levels. Finally, the share buyback program has been a meaningful source of value creation. By reducing diluted shares from 7.6 million to 6.9 million over 3 years, management has amplified per-share earnings growth even as top-line revenue has been relatively flat. If this capital allocation discipline continues, it should provide a floor for per-share value creation even in a challenging revenue environment. Bear case. The bear case starts with the single most powerful force in modern finance, the relentless shift from active to passive management. This trend shows no signs of abating. In fact, it may be accelerating as a new generation of investors, raised on the gospel of index investing, enters their peak earning and investing years. Every dollar that flows from active to passive is a dollar of potential fee income that VRTS will never see. Fee compression is destroying margins industry-wide, and VRTS is not immune. The company's average fee rate of approximately 42 basis points is under constant pressure as competitors cut fees to retain assets and platforms demand more favorable economics. Even a few basis points of fee compression across the platform translates to tens of millions of dollars in lost revenue. Talent risk is the Achilles heel of the entire multi-boutique model. The departure of a key portfolio manager or team can cripple an affiliate overnight. Kayne Anderson Rudnick, which accounts for 40% of total AUM, represents a particularly acute concentration risk. If KAR's leadership team were to depart, or if their investment performance were to deteriorate meaningfully, the impact on VRTS would be severe and potentially irreversible. Scale disadvantages relative to the mega managers are real and growing. BlackRock, Vanguard, and Fidelity can spread their technology, distribution, and compliance costs across trillions of dollars in assets, achieving per-unit economics that VRTS cannot match. In an industry where scale advantages are becoming more important, being the smallest publicly traded multi-boutique platform is a vulnerable position. The dependence on M&A for growth raises sustainability questions. VRTS has executed well on acquisitions historically, but the pipeline of attractive targets is not infinite. As the market for quality boutiques becomes more competitive, with private equity firms, sovereign wealth funds, and larger asset managers all bidding for the same properties, acquisition multiples may rise to levels that make deals less accretive. Finally, the complexity of the multi-boutique structure makes the true economics somewhat opaque. Revenue sharing arrangements with affiliates, amortization of intangible assets from acquisitions, and the consolidation of entities with minority interests all make it harder for investors to assess the underlying profitability and sustainability of the business. This complexity can weigh on the stock's valuation multiple. Key KPIs to track. For investors monitoring VRTS's ongoing performance, 3 metrics matter above all others. First, organic net flow rate. The percentage of beginning of period AUM represented by net client flows, excluding the impact of market movements and acquisitions. This is the single best measure of whether the company is winning or losing the battle for investor capital. Positive organic flows indicate that the product lineup, investment performance, and distribution efforts are working. Persistent negative flows, as the company has experienced recently, signal that the business is shrinking at its core, even if acquisitions mask the decline. Second, investment management fee rate. The blended average fee earned per dollar of AUM across the entire platform. This metric captures the combined effects of fee compression, mix shift between higher fee and lower fee strategies, and the success of the company's push into higher fee alternatives. A declining fee rate, even with stable AUM, translates directly to lower revenue and narrower margins. Third, operating margin adjusted for affiliate revenue sharing. The percentage of net revenue, after payments to affiliates, that the corporate parent retains as operating profit. This metric strips out the pass-through economics of the affiliate model and reveals the true profitability of the platform itself, the infrastructure, distribution, and corporate overhead that VRTS provides to its boutiques. The VRTS story offers a dozen hard-won lessons, but a few stand out as particularly instructive for founders building businesses and investors evaluating them. Survival is the first strategy. VRTS was born at the worst possible moment, spun off into the teeth of the worst financial crisis in 80 years, with assets hemorrhaging and no natural shareholder base. Many comparable firms did not survive this period. VRTS did, not through brilliance but through prudence. The Harris Bancorp capital infusion, the disciplined management team, the patience to wait for markets to recover. In investing and in business, the ability to survive bad periods is often more important than the ability to capitalize on good ones. Warren Buffett's first rule of investing, don't lose money, applies equally to corporate strategy. Find your differentiation or die. VRTS could not compete head-on with BlackRock on scale, with Vanguard on fees, or with the largest active managers on brand recognition. Rather than trying to be a slightly smaller version of the giants, Aylward built something structurally different. A federation of specialists united by a common platform. This is the classic strategic insight from Michael Porter. When you cannot win the existing game, change the game. Alignment matters more than control. The genius of the multi-boutique model, when it works, is that it aligns the interests of the corporate parent with the interests of the boutique investment teams. Equity participation, revenue sharing, and operational autonomy keep the people who generate the value, the portfolio managers and analysts, financially and psychologically invested in the outcome. The corollary is that misalignment, through excessive corporate interference, unfair economic terms, or cultural disrespect, can destroy a boutique faster than any market downturn. Distribution is the moat, not investment performance.